We all know that income tax rates are going to go up. And I'm going to be more specific about that as we go on. But the question then becomes, okay, if we know tax rates are going to go up, partly because of the new administration, partly because of a bunch of other reasons that we'll be talking about, what is the appropriate response for IRA and retirement plan owners? And in addition to taxes going up, we have to contend with the Secure Act, which is really a massive income tax acceleration at the death of the IRA owner, which we're going to talk about in depth. The, let's say, theme, if you will, of today's webinar, and this one is mainly going to concentrate on what I would call living strategies. We have another 2-hour webinar that is more what I call the dying part, or the estate planning. And there's obviously some overlap, and there's obviously a continuum between retirement and estate planning. But the theme is going to be transferring taxable assets while we're in a lower income tax environment to tax-free assets. And we're going to be talking about that both in the context of retirement planning, that is for you, your family, your client's family, but also we're going to be talking about that in context of estate planning, meaning your kids, your grandchildren, or whoever else your heirs are, as well as the heirs of your clients. So the course is going to really be on, let's say, what you can be doing now that will have an impact for yourself and your spouse and your clients. And the sequel, which I believe we call the best estate plan after the new administration, is going to be more the dying part, where we talk more about wills, trusts, beneficiary designations of IRAs, etc. And as I mentioned, it's really a continuum. I don't say, okay, we're done with retirement planning, now let's do estate planning. Again, it's all really one continuum. But again, the theme is going to be transferring money from the taxable accounts. All right, so what am I talking about? And mainly IRA and retirement plan owners. We're talking about IRAs, 401ks, 403bs, SEPs, KIOs. What all of these plans have in common is that no one has yet paid income taxes on this money. So let's say that you have one of these plans, most likely an IRA or a 401k, or your clients have that and you're planning for this. This is money that is a combination of your and your client's money and the employer's money that no one has yet paid income taxes on. But someday, unless you leave it to a charity, someday somebody's going to have to pay income taxes on it. So the question is when, but all of these things I would say are part of the taxable environment. And what we're going to take a look at is, well, is there a way that we can take some of these taxable assets, even cashing them in now, which kind of goes against what I've really been saying for close to 30 years, pay taxes later, cashing them in now, and then taking the proceeds of those funds after we pay the taxes on it, and taking those proceeds and putting them in a tax-free environment. So for example, Roth IRA conversions are the most natural thing to think of when you think of income tax-free growth, but also we can also look at some of the things like 529 plans and life insurance and your heirs, Roth IRAs, 401ks. And the advantage of some of those type of plans is that it is not only income tax free, but it is a method of transferring money out of your estate, which is going to become more and more important as we see with the sunset provisions of the Tax Cut and Jobs Act of 2017.